Let's touch base with John Woods, who's the Chief Asia Strategist at Citi Pvt Bank. John, it's good to have you on the show. Thanks very much for taking out the time. Despite the rally in Asian equities, you maintain an underweight on the region. Why is that?
Well, look, we've preferred to play Asia over the last year or so through the credit market, and I think it's been the right decision. Since 2011, we've managed to make about 10% both in local currency debt and US denominated debt, compared to, say, minus 5% in the equity space. So yes, equities have rallied aggressively in the last 2 months. Whether that's going to continue is purely a function of the hot money that flows into Asia and then flows out of Asia. We've preferred, on behalf of our clients, to take a slightly more prudent, cautious approach that has generated positive, I would say attractive returns, and we've avoided somewhat the volatility caused by these spikes in equity.
The LTRO facility and the second tranche that's been supplied to the banking system, what would it do for the overall flows into the Asian region, as that's an aspect closely monitored?
Little early to say as yet. Certainly we've been seeing in the last few weeks declining inflows into equity markets from foreign investors. We've seen actually declining volumes in equities themselves, albeit on rising prices. And that, to me, is a bit of a warning signal. When you have declining volume and rising prices, it tends to suggest that there's a turning point nearby. And I think in order to get a sense of what that will be, we need to look around for catalysts. Oil is an obvious one. I noticed the Greeks haven't signed, or the EU has not fully signed the bailout package of Greece yet, so that could be a catalyst. But overall, LTRO is a double-edged sword, as we all know. Liquidity can flow in very quickly, but it also can do the opposite.
Despite absolute flows being high, relative flows into Asia as a percentage of the EM pie have been only 1.5%, as you mentioned in your report, versus 4.7% in the, in the same period over the past 10 years, and that's the first 3 months that we're talking about. Why is that?
Well, I mean, I think the simple answer is better opportunities elsewhere. I think the slightly more in-depth answer is a rather critical look about Asia's growth model and its reliance on developed markets. What we're essentially seeing, obviously, is investment and exports driving growth in general terms, and when demand in developed markets diminishes, particularly in the European Union, which is for many countries their largest trading partner, when we see the mild recession possibly accelerating into a deep recession, obviously markets get somewhat nervous. We have the overlay of a high oil price potentially impacting inflation concerns. The last time that happened, bear in mind, was the first half of last year, and we had that massive outflow of capital from Asia, which caused our markets on the full year to fall by 20%. So I think these are the reasons why investors are a little bit cautious. I guess they want to get a bit more comfort over China's slowdown, albeit hard or soft. They want to get a little more comfort about the bottoming out of growth in Europe before, I think, substantially money starts coming back in size.
Just wondering, John, if indeed the kind of money that is getting pumped into the system via LTRO or other measures as and when they are taken, would this lead to potential asset bubbles if it hasn't happened already?
I think there probably is going to be a chance of one. Of course, it's an entirely negative phenomena. This is, of course, where banks are essentially unable to fund themselves effectively or profitably in either retail markets or interbank wholesale markets, and are depending really on concessional cash rates from the ECB as a consequence of this credit crunch or funding stresses in the interbank system. It actually is representing or playing out as pretty much a carry trade. By the looks of it, banks are borrowing from the ECB at very low rates, around 1%, and a large part of that's finding itself into assets such as Italian or Spanish bonds, where there's a 5% yield, and of course that carry is highly profitable for banks. as they seek to repair their balance sheets. Unfortunately, very little of that probably will find itself into the real economy, i.e. to the small and medium-sized businesses that need that liquidity. And for as long as banks are essentially asset managers rather than lending institutions, demand for this cheap capital will remain high, and to that extent I suspect there is a likelihood of a third round of funding.